Welcome back. Another episode of Exploring the Process. I'm kind of losing count on how many episodes we're on now, but I think it's episode 14. That
Well, no,
sounds
I'm
about
sure.
right. Yeah,
I'm sure we passed 15. Did we?
15. I'm not sure. Anyway, it doesn't
Okay.
matter, but it's a glorious Friday morning here. We're doing this on April 29th, and it's going to go out later today. So this is real time, baby. Normally we kind of record them earlier in the week, but this is real time. I was having some thoughts. Anyway, we're gonna kind of play around with some stuff. We do have some guests coming back on. I know I keep teasing that out, but we are lining them up. It's just kind of schedules haven't quite aligned. So you got Chris and I back in the house again. Welcome, Chris. You doing well?
Yeah, I'm good, buddy. How are
Yeah,
you?
I'm great, man. Nothing. No concern. Like just really nice. Yeah, it's just a good day. It's been a nice week. The springs here in the Northeast. It's awesome. It's still cool, but it's like it's just like kind of peps up your mood a little bit.
Nice. Do you
Yeah,
suffer from SAD?
SAD, what is that? Oh, sunshine, like
Seasonal,
a
what's it called? Seasonal
seasonal.
dysfunctional disorder?
No. If you haven't noticed, I'm pretty much a jolly guy all the time. It's just sometimes, you wake up and you're just in a really good mood. So it is what it is. But today we are going to talk about going back a bit. I say basics, but it's not really basics because it's just something that you're always having to tweak and fine tune. But at the end of the day, it's just sizing is really what we're going to talk about, and sizing not necessarily against like your initial capital, but sizing the capital that you can actually take out of the market. And this is something that you and I talked about either earlier this week or last week together. And it was a great topic, and I think something that is not really discussed a lot about. So I'm going to kind of pass the baton over to you, Chris, to just sort of lay out what the way you think about it and the concept, and then we'll dive deeper.
Cool. So it's something that I came up against. It's a problem that I had myself, and I didn't. It's one of those things that you don't know. You don't know the mistakes you make until you're kind of shown them or you figure them out, and then you're like, oh, why didn't I know that? So it's about a new position size. So in the scenario that I talked about, so let's just say your account size is $100,000 and you have X amount of trades that are open and they have 50% gains, okay? So how that would be in one of my accounts, there would be a little black number that would say 100,000 and a little green number that would have 150,000, which was your unrealized. So the 50,000 is your unrealized gains because you haven't closed the trades yet.
Yep.
And the other little green number would say plus 50%, okay? Now, what would catch me out is if taking everything else out, taking everything else that it doesn't matter what the next trade is because of your position size will be different depending on the asset. Taking all of that out, you received an RTA from Keith and it specifically said in this asset, open a 1% position size. Now he never does that, but in our scenario, that's what he's telling you. He's saying open a 1% position in this. Okay. So what size would it be? Which number do you use? Now, the old me would have used the 150.
Yep.
Okay, which is fine while your trades are going well, while you're still, well, whether it's a long or a short, just as long as it's going the way you expect, that's fine. But it's when it goes against you that you figure out that what you've actually done is you've layered on leverage.
Yep.
Because the 50,000, so if your 1% position size was $1,500, you've layered on a layer of leverage, i.e. the 500, that is never yours. It was never yours. It's not yours yet. You haven't closed the other trades. So that 50,000 doesn't belong to you yet. The 100,000 belongs to you unless other trades go against you and whatever else. But at the moment of opening that trade, that 1% position size, for me now, the Chris now against the Chris of old, only uses the 100,000 because that is my money still.
Yep.
Any profits from unrealized gains, they don't belong to me yet. They still belong to the market. So I can't use them to size my next position.
Right. And so then, if you do realize, say, $10,000, then you move that number up to 110, and your 1% position would be 1,100 versus 1,000. Yeah. I think it's a really good concept, and one that again, it's not admitting anything. I probably do a hybrid of kind of a little bit of both. Right. And when after our discussion, I kind of went back and thought about it. And I was like, again, not really depends on the day, but I use basically like total account value, which is a combination of basically the positions I have on in the market plus cash on hand, right? So, that is the number that I typically use. And normally that number does get kind of like adjusted with position, because the way that I'm at Schwab currently, and they basically that account value obviously fluctuates. So it's interesting because like I, unbeknownst to myself, basically was doing that, but I was just using that that account value number that's like on the top left of my screen. Now, I have gone back in the last week or so and been looking at and making sure, right, that those numbers basically match up, and luckily they do. But I could 100% see how you could get yourself absolutely called out on that. And again, it was just pure luck the way that Schwab had it for me personally, because I definitely would have been doing like basically looking at my total value. And now, so I say that because some of that total value, so like that number does capture, like if I'm if I'm positive on stuff, like it does go up. So that is one thing that I have had to adjust a little bit, because obviously it's that's why I say it's kind of like a bit of a hybrid. So I've become much better at looking at, okay, here's like my total cost in the market in terms of like what's out there, and then versus like, okay, to your example, like if it's 100 to like 110, I'm, rather than using the 110 plus cash, which is really what that total account value is, I'm using 100 plus my cash, right? So it's just basically whatever's in the market plus that number. So I've definitely adjusted it. But luckily, I don't think I was getting myself caught offside that much, which is a good thing. But it's
it comes down, like if you're using, if all of your ideas, or if all of your trading is coming from Hedgeye, you're less likely to get caught out by it, because they are doing the correlation side of it. So correct. Keith is thinking, this new position, how much does it correlate with everything else? So why it used to catch me out predominantly when it was just trend following and nothing else, is that if the 10 trades that were giving me that 50% gain were copper, silver, lead, aluminium, iron ore, corn, and wheat, and then I had to open a position in silver, let's say, then that's where it catches you out. Because if you then make your new position sized off of
the total
unrealized gains, the total 150,000, then if the ones that are giving you the profit turn against you, and it's highly correlated with your new profit, with your new position, one, your unrealized gains are going to fall. Two, the new position is correlated with everything that gave you those.
So it's moving down.
So immediately, almost straight away, if the trade goes against you, automatically your position is now too big.
Yeah.
So one, it's oversized, it's highly correlated. And so that's where when everything's going right, it's why sometimes, especially in trend following, if you don't volatility adjust your position size, it's how you can go from having, and it could potentially be what happens quite soon, is you can go from having massive up months to all of a sudden be on the other side. You go from having a massive up month to a massive down month, because that, like I said, that kind of hidden leverage then compounds on the way down. It's hidden on the way up because it's working.
Yeah.
And then all of a sudden, when it catches you out is when it goes against you, because like I said, you've got hidden leverage and your position size, any subsequent position size is now too big.
Yeah. And I got an email earlier this week or over the weekend, and it was kind of along those lines where, this person, and again, I hope, they don't mind me speaking on it here. But basically, they new to Hedgeye, have a 401k, they're limited to certain funds, and they basically had gains this year, but their funds are basically energy, natural resources, commodities, I believe gold or something like that, right? So those basically are, well, three out of those four are pretty highly correlated with each other. So, as they went up, that asymmetry certainly was masked, right? So like the lack of asymmetry was masked, and it's something that Keith has been talking about the last couple of weeks on um, the notebook reviews, is this concept of asymmetry. And again, he's talked about it many, many times, but for whatever reason, it's definitely stuck with me. It's like it finally cracked the skull in the last like 2 to 3 weeks. And it's something that I'm, really focused, again, it's like, it's important to really, because it's not necessarily that difficult to understand in practice. It can be difficult to actually deploy and to make sure that you're not getting yourself over correlated with each other, or like the asymmetry is truly there, right? I mean, it's kind of it's likely one of the reasons why he's sort of dipping his toe back into some different fixed income exposures and looking for other kind of asymmetrical ways of expanding that. And again, Chris, you're absolutely correct, because on the ETF Pro product, those are, they factor in the correlation between that basket of both, longs and shorts. But the asymmetry, and going back to this person's question, she's like, she said, I don't want to lose these gains and like, where do I go? And the question is like, well, that's a very challenging question to answer from my perspective, because one, I'm not an advisor, right? So, and I don't know what funds, you have available. And I also, but from a process standpoint, from like thinking about it from Hedgeye, you got to look at what you have available to you to invest. How often are you going to be touching the position? Which again, so like, it's how often are you going to, can you trade in the 401k or make those adjustments? What funds are available? And then, what is the time horizon? So 401k is typically longer term. So, there's a big difference between thinking about what's going to transpire here today in quad 4 in Q2, and the potential quad 1 in Q3, and then back to quad 4 in Q4. So to me, that's sort of, it's a tricky situation, because you don't know if quad 1 is going to be a rip roaring exposure, but having, again, in this fund scenario, in this 401k, let's just say there's, value or quality, right? So like, that's going to get you your equity exposure. So you definitely want to have some exposure to that, given the fact that we're calling for disinflation over the course of the, to the end of the year and what have you, taking down that commodity, and certainly, maybe not natural resources, but certainly commodity and energy exposure would make a lot of sense. Maintaining that gold exposure, but then having that asymmetry, as I just said about the bonds with Keith, looking at what bond exposures are available to you. Do you want the long end of the, do you have a fund that gives you the long end of the curve? Do you have a fund that gives you international exposure? Again, just kind of having a bit of a diversification there, but also, again, if you're new to the process and you're not going to be, it's not even trading in and out. It's just, if you're sort of sorting it out, then, cash is also okay. And just having patience in terms of like getting a clearer picture, like, so that would be my, again, it's 2 cents. But I'm not an advisor, but that's sort of, it's important. It goes really well with like the asymmetry of the portfolio, right? Especially if you got a longer term outlook. And many advisors, like many, I don't know why I use air quotes, but many pros that like leverage Hedgeye, they have to, it's a bigger challenge than on the personal side, because I can, I don't have anybody, I don't have the SEC breathing down my back, right? I can kind of basically, again, I don't necessarily whip around, but I can trade 50 times a day and no one cares, but it's a lot harder to do that in like a professional manner. And so kind of, having that longer, trying to position the portfolio for the longer outlook, for the full cycle investing, personally, I think we're just there today, in terms of like, we're hitting quad 4, the Q2 earnings that will hit in Q3 are going to be, suspect. Even with GDP maybe, growing, it could be a very similar situation where we had in Q1, where it's like basically the market still acted quad four-ish, but we were in like a quad three type of, technically in a quad three type environment.
Yeah.
Yeah.
It's a question came up on the arena today about the dollar, and it's a new subscriber. And like, I get it. Like, we joked before about, well, utilities didn't really do it, but we joked before, everyone was saying that utilities was just at the top end of the range, would never go at the low end of the range. And it's like, it's having to balance, because you don't know how they were investing before.
Correct.
So it's like, if you were in the, if you were in this realm of, like 2014, 2015, people were coming to me talking about uranium. Now, that was dead money for 5 years. It worked in the last 18 months, great, but it was dead money for 5 years. So if you're in that investing mindset of, oh, this is going to work, and you're happy to sit with money for 5 years, and now all of a sudden you come to hedge, it's like, so much can change. Yes, the question is, like, should I just buy some UUP today because it never goes to the low end of the range?
Yeah.
Right. And it's like so much can change in 6 weeks. It's like, yes, we have this roadmap of what might come for the next year, so to the end of 2022. It's like, but so much could change.
Yeah.
Look at the Japanese yen. Everyone's like, oh, well, the yen is a long in quad four, but why are the BOJ doing this? It's like, who knows, but they are.
Yeah.
So don't be long it. You need to be short it.
Correct.
Right? It's like, yeah, okay, the dollar might never go to the low end of the range. It will, and that's this is how I tried to explain it. I said, where it is in the range is just a probability of where it's going to go next. So you need to be patient enough to say the higher probability of me getting a good entry is at the low end of the risk range. But to be humble about it and to be patient about it is to say that the next time that it's at the low end of the range, it might be higher than it is today.
Correct.
Today it's at 103. And in 2 weeks' time, when it's at the low end of the range, which is a better entry probabilistically, it might be at 104.
Yeah. Yeah.
But I'm going to get in at a better price with the potential of it going higher.
Correct.
And that's the hard part, especially for, I don't know how new he is, but that's like, I need to get, and of course it's about, the question came about the dollar, which is going up. It's like, the question's not about gold. It's like, well, what you should be doing is you should be buying gold.
Well, that was
right?
going to be my segue, right? It's like gold is a perfect example. It's, and even bonds until recently, basically until you mentioned, I think on the macro show yesterday, about like basically putting in some new bond exposure, it's fixed income wasn't being talked about, right? And again, it's like bullish trend and all that kind of stuff. But I sort of alluded to this at the beginning of the notebook review the other day, is that there's definitely components there that are looking better in fixed income.
But it's just not TLT.
But it's
just
correct.
It's just not the big ones.
Correct. And the other component there, and something that you mentioned to me, is TLT, or certainly just treasuries in general, especially with what's going on in Japan and Europe, et cetera, et cetera. I mean, there's more forces that utilize the treasuries to basically, I don't even know if hedge is the right word, but just sort of to adjust and offset and have it basically almost have like an asymmetrical portfolio for themselves. And we're talking, like the $1 trillion, like, maybe not trillion, but trillions of dollars, basically leverage it within pensions, whatever it is in global economies and countries across the world, that impacts basically the way that the treasuries trade. And so it's something just to keep in mind. And anyway, yes. So
if you want to really go down the rabbit hole, there's all kinds of things that people come up about, but the one simple one, and that's what I mean, this isn't the reason, but it's a very simple answer that it could be, is that trend followers done really well last year. So coming into this year, people may have increased their allocation to trend followers, which means even just going from 2% to 5%, let's say, as an example, in some big funds is massive.
Yeah.
And all of the trend followers were short bonds.
Right.
So it means any incremental money that came in the start of 2022 just made those short positions even bigger.
Yeah.
Now, I'm not saying that is the answer.
No, but
taking all of the nonsense about the Treasury and the Ministry of Finance in Japan and all this and that, and Saudi Arabia is taking all of that out.
Yeah.
Trend followers done well. Trend followers potentially got more money allocated to them this year, and they were all short bonds, so they had to increase their short bond position.
Yeah. And again, basically it's human nature, right? Like if you're sitting there in a boardroom and you're like, okay, well, this fund was up 35% and we only had a 2% allocation to them. Why don't we make it 5% this year and see if they can see if they can repeat, see if they can even just give us 20, even if they can just, get us 20, whatever it is, if they can repeat that or do better, then let's just give it a go. And they've outperformed for the last 5 years, let's just say, right? There's some numbers that basically tell you, okay, historically they've done better than the market, they've had a good track record, and let's see what happens. And they basically right now, depending on how good they are, they may have walked into basically
all the downside.
Right. Yeah, all the downside. Exactly. The one year that they completely underperform.
Exactly.
But that's neither here nor there. So the other thing that again, we're going to wrap up here in a minute, but so when you look at correlations and like asymmetry, is there anything in particular that you really focus on per se to help you kind of make sure, or is it more just factors, exposures, classifications, just knowing that, as you, to your example, if you got a basket of commodities, that if you add another 2% of silver, that's going to take you to like 10% in commodities, and that's just over your max. So you in that scenario, maybe you'd take down, I don't know, 25 bips across all of your current exposure, realize those gains, and then you add silver or something.
So it depends on the balance. So it depends on how, like, your net position. So it depends. So if I might have 40% of my portfolio in commodities, but if half of them are long and half of them are short, then it's nothing set in stone. Mine's is more based on much the same as key if it breaks trend. So if I'm short it and it breaks trend and starts going and turns bullish, then I close the position. I rely more on my entry and exit to define it more than correlation.
Sure. And then do you give it a day or two to kind of confirm trend?
Yeah. I think it's smart. Gold's a good example right now of just, it's flirting with trend basically, right? It's hanging in there. It's flirting with my version of trend, but it's not flirting with Keith's version of trend, because he said trend was 1850 yesterday.
Fair. Yeah. I mean, but it's like,
with anything, it's like anything, right? So it's like,
I mean,
that same correlation that we're trying to talk about between assets. It's like, well, how correlated am I? So for instance, someone made a post the other day saying it's unethical that somebody is trading Bitcoin like a tech stock. And I'm like, well, no, it just means that people who own Bitcoin probably own quite a lot of Tesla and whatever else. So it's just trading with the people. All you're doing is trading with the people that own Bitcoin.
Correct. That doesn't make any sense. So you have to understand.
He clearly didn't know that. But the fact that he called it unethical.
Keith on the call this morning said it had 100% correlation with the NASDAQ.
Exactly. But what I'm saying is at any given point, just like any trend. So like right now, people who are going into commodities now, would you want to be correlated as a cohort of investors with the people who are coming in at the end?
Correct.
Regardless of whether corn is breaking trend or doing this, or copper
Well,
is
that's
doing
where,
that, or silver. It's like, would you want to, taking the assets aside, do you want to be correlated with the people that come in at the end?
well, and that, so Trend Wizzo texted like last night and saying that, he basically put on a position in crude oil, and I was, again, sometimes it's just different mentality, right? Because like my mentality is like, why would I, why? And I said this to him, so I'm not like, I'm not saying anything that he doesn't know or like talking badly. It's just, I literally said, I was like, why would I try to chase the last 4% of a move when there's a greater probability of potentially 20% downside? So if I have patience to wait again for a lower confirmation of another lower high, excuse me, on accelerate, let's just say it's a perfect example. Let's just say it's the perfect trifecta, right? Lower high, increasing volatility on decreasing volume, right? So it's the perfect trifecta. That to me is a way better setup. Again, I mean, it's just different trading, different investing. And again, and he responded back like, I got a trailing stop. I'll go both ways. And that's totally, and that is 100% cool, and I think in today, this morning, he's proving correct. Like,
so I looked at oil exactly the same this morning. Okay, so it's bullish. So on my signal and on Hedge Eyes, it's bullish trend. Okay, but right now, depending what it does, it's now failing to make a new 1 month high on my signal.
Yeah.
Okay, so in my terms against that is I missed it trying to make. So I didn't buy the dip effectively. I didn't buy the dip at wherever it got to 100.
Yep.
Now it's at 106. So now my next trade is, even though it's bullish trend, it's now failing to make a new 1 month high unless it carries on going this morning. But that also is a signal that my trend is probably going to change. Correct. So even though the little symbol is green, today, I know that when it doesn't make that new 1 month high, it's going to lead it to changing it to neutral.
Correct.
So this is the part of Keith shares everything that he can without giving everything away, but he knows what's going to change in the quad. He knows what's going to change in his risk ranges because he knows how the numbers are calculated.
Correct.
So it's just as much of a signal if he doesn't signal to buy oil, right? Because because there's a potential that he's like, right, if this fails making a 1 month high, then it's going to change to neutral.
Correct.
Potentially.
Again, it's all probably, again, like the thing about it is it's all probability weighted decision making. That's exactly. That's the beauty of the fucking process, is that
it's at the top end of the range. So the probability of it going higher is lower than it was.
Correct. Yeah. Anyway, and I'm not picking on trend or anything like that. It's just a good example of different trading styles and different focuses or different approaches to the game. And that's the beauty of it. And that's why we have this platform right here, Chris, is because it's exploring the process, and it's your process. Your process is different than mine. My process is different than,
right? To tie it right back to where we started. if you were right and shorted everything on whatever it was, the 24th of March or whatever it was, thingy of April, if you shorted and you now have a load of unrealized gains in all your shorts, and you now make your oil long too big today and it goes against you, then you've compounded your error.
Completely. And that's a great way of tying it back in the beginning of the conversation. And position sizing, I cannot express enough. We talk about it a lot on this channel, and it's crucial, right? And I mentioned this on Twitter the other day, right? At volatility north of 30, really just pretty much north of, let's say 25, really, you bring down your max position sizing, right? So if it's normally in, say, let's just say VIX less than 25, if your max is 6% in the US equity ETF, when it's north of 30, you bring that down to 3 to 4%. So that's like step one. Step two is going to that next level, which is what you just said, which is make sure that you're not, compounding your
potential error.
Potential error when if you're putting on a position that is bigger than it should be. And it goes the other way too. Let's just say you're down on the year, right? Let's just say you started 100 and you're at 90,000. Well, I don't think many people would still put on a 1% position, or like $1,000 position. They would put on a $900 position. But it's really important, if you are still going with like your core cost of capital, that's not accurate, right? So it's like, if you're down, you got to adjust that position sizing as well, because those unrealized losses might shift to gains, but you don't know that. The market's telling you that that's not the case, and you just got to be cognizant of what's transpiring, right, in the game that you're in. So it's good convo. I appreciate your time as always a pleasure. I know you got to go pick up the boys from school,
get the kids.
Yep. But we'll be back next week, and we're going to tease it one more time. We're hopefully pinning down Rich, who is the next. Again, I always joke, or I think, I forget, somebody told me you're never really ex-military, but he was a U.S. Air Force pilot, and so should be a really fun combo. He's an OG in the space and the Jedi. So we'll get some more guests back up on here, because I know it really does help across the board and that kind of thing. So thanks for your time listening in. We really appreciate it, and looking forward to having more of these. And you'll be coming to Hedgehog Live, which is in like 2 weeks, which is awesome. So we'll maybe we'll try to do something around there. We'll figure it out. I don't really have a game plan yet, but if anybody's got a suggestion, open the ears.
All right, buddy.
All right, boss. Have a good one.
Bye.
Yep.
Bye.